Hello, and welcome to today's webinar. My name is Catherine, and I'll be in the background answering any WebEx technical questions. If you experience difficulties during the WebEx session, please dial 1-866-779-3239, or you can message myself, the WebEx producer, using the Q&A panel. During today's event, all participants will remain in the listen-only mode, and as a reminder, today's call is being recorded. We will hold a Q&A session at the end of today's presentation. We encourage you to submit written questions at any time using the Q&A panel located on the bottom right side of your screen. Please type your question into the text field and hit send. Please keep the dropdown as all panelists. I would now like to introduce your first speaker for today, Sharif Abdu. Sharif, you have the floor.
Thank you, Catherine. Hi, everybody. This is Sharif Abdu. I'm a senior analyst here at ValueLine. I'm joined today by two other senior analysts, Alan House and Charlie Moran. We here at ValueLine hope you and your family are staying safe and dealing with this still difficult time as best as possible. So today we're going to provide an update on the COVID-19 situation and its ongoing impact on the economy and the stock market. We will also discuss the actions that ValueLine is taking to help our subscribers navigate this still challenging time. We will then recommend one stock to buy right now, and finally, we will take some questions from people in the audience. Please note that this presentation will be available on our website. It's valueline.com, VALUELINE.com. As well as on our YouTube channel within the next 48 hours. All of our previous webinars are also posted on our YouTube channel, so please go ahead and take a look when you get the chance. Before I jump into the heart of the presentation, for those of us joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation. We've been providing investment research for more than 90 years. Our flagship product is the ValueLine Investment Survey. I'm sure that many of you are familiar with it. This service is a unique source of financial information, and it's designed to help investors make informed investment decisions that fit their individual goals and levels of risk tolerance. The ValueLine Investment Survey includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy to follow model portfolios, stock screens, industry-based analysis, and much, much more. So our service, which is published weekly, is created by ValueLine's research department. And that department is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing that we like to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including all the equities that we cover. ValueLine does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own any shares of any company that they cover. If you have any questions about the products or services that we offer, or for our different tiers of subscriptions, that information can be found again on our website. That's valueline.com, VALUELINE.com, or you can call our toll-free hotline. That's 1-800-VALUE-LINE. Okay, so with the housekeeping out of the way, let's talk a little bit about the current economy, the ongoing COVID-19 situation, and the stock market. First, I'm going to open with a little bit of commentary from our economic staff. And I quote, "The Federal Reserve rendered its final monetary policy decision of 2022. At its mid-December Federal Open Market Committee meeting, the central bank raised the benchmark short-term interest rate a half point to a range of 4.25 to 4.50. Which marked the highest level since December of 2007. The Fed also continued its $95 billion monthly bond selling program. These moves are designed to decrease the money supply, with the expectation that less liquidity in the financial system will lead to reduced demand for goods and services and ultimately put downward pressure on prices. Investors were surprised that Fed Chair Jerome Powell indicated that rates would likely not come down until 2024 at the earliest. Moreover, the FOMC upped the 2023 interest rate target to 5.10. A Fed statement showed that 17 out of the 19 senior central bank officials believe that this benchmark federal funds rate needs to rise above 5% and stay at that level for some time in order to effectively fight inflation. Thus, concerns persist that the Fed may misstep on how hard it hits the monetary policy brakes in 2023, with the possibility that it can push the nation into a recession. So on point, the housing market is suffering from higher mortgage rates. Likewise, the consumer is having to borrow more money at higher rates to purchase both discretionary and non-discretionary items. We think this will put added pressure on their spending down the road when the bills on those purchases come due. Credit card balances rose 15% in the third quarter, the highest year-to-year increase in 20 years. The expectations for corporate earnings are weak. According to FactSet Research, profits for S&P 500 companies are estimated to have declined nearly 3% in the fourth quarter of 2022. And the prognostications for calendar 2023 are for shrinkage in earnings. This may put downward pressure on near-term stock valuations. In conclusion, the stock market sold off on the recent hawkish commentary from the Federal Reserve, and with corporate earnings likely to decline over the next few quarters, stocks may face an uphill battle, particularly as to the equities of less profitable entities. Thus, we recommend a portfolio tilted to financially strong companies and with a healthy amount of cash to be deployed a bit later in the market cycle. Close quote. So now that we got that commentary out of the way, I'm going to just touch on one section or one particular sentence from that commentary. We recommend a portfolio tilted to financially strong companies and with a healthy amount of cash to be deployed a bit later in the market cycle. That's really part of our core belief at Value Line, is that equities can play a core holding, whether it's an up market or a down market. But in times when there is some uncertainty, the economic picture is a little bit clouded, like it is right now, it's really a good idea to focus on the financially strong companies, companies with healthy balance sheets, companies with ample cash flow, companies that can withstand, that have the financial wherewithal to withstand, difficult times. So on that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, our time-tested ranking systems, and other valuable services. In addition, Value Line provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, etc., and to find information that may change our view and investment recommendations for specific stocks. When something that is noteworthy does cross our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what that information means for the stock and for shareholders. This content is posted throughout the day on our website. Again, that's valueline.com. So right now I'm going to give you a little primer on how you can access our website. And once we are signed in, we're going to head over to the dashboard. So let's see where we are right now. So there we are. That's our Value Line homepage. That's sort of the dashboard. That gives you a broad overview of all the content that we have created for that day. As you can see there, it says Stock Market Today, December 22nd, 2022. And that is commentary. That commentary is provided 5 days a week. Every day we provide commentary for when the stock market opens, and often we will provide commentary or updated commentary when the stock market closes. Alan, if you want to zoom down a little bit and look at the supplementary reports. I see them in the quick links section there on the right side of the page. There you go. So as you can see, we have supplementary reports that are written every day, and that depends on whether there's newsworthy, noteworthy information about the stock, whether that's an earnings announcement, something to do with an acquisition, something to do with a merger, or other kind of noteworthy information that might move the price of the stock. Okay, so I'll touch on another thing, is that some individual companies incurred a lot of debt or sold stock to improve liquidity over the last 2 years, especially companies that have been dealing with sharply reduced demand for their offerings or supply chain problems, among other issues. So due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary grades for stocks. That includes financial strength grades, safety ranks, other rankings. These changes are posted each week in our Selection and Opinion newsletter. And for those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are two of the metrics that are used to calculate a stock safety rank, which is a very important measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that for the case for individual stocks is quite strong. Just to reiterate that, certainly particular industries and sectors will recover more quickly than others, but we think that the case for individual stocks remains very strong. So with all of that out of the way, let's get into the screener and into the screening process. Alan, if you want to take us to the screener, we can get started there. So as you can see, that Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this is of interest to you, please call 1-800-VALUE-LINE. Okay, let's get started with our screen for today. Now, the current economic environment remains uncertain. It's marked by elevated inflation, rising interest rates, and the possibility of a recession. So today we want to emphasize a good balance between financial stability and upside potential in the intermediate term. Okay, that's what we're looking at. We're looking at a balance between financial stability, but also we wanted to look at companies or stocks with good upside potential, let's say in the next 18 months, okay, the intermediate term. So we'll start the screening process by looking at safety and financial strength ranks, and that is in our ratings and ranks section. First up, safety. We want stocks that have a safety rank of 3 or better, okay? There are many risk measures to consider, but today we're going to start by applying our time-tested safety ranks. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 to 5, with 1 being the most conservative issues, okay? I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. So it's kind of a win-win situation. They hold up better when the market is down, and they still participate meaningfully when the market is up. So win-win situation. For more information, I encourage you to take a look at our ranking system guide, which is available free of charge within the investment education section of our website. So we're going to focus on stocks with a safety rank of 3 or better. By applying that first criteria, we've already trimmed away, we've cut the entire list of possible stocks down from about 5,700 down to 2,086. So we've already chipped away about 2/3 of the potential stocks. We've got it down to, about 1/3 of the value line universe. So the second thing we're going to look at is we're going to apply another level of security by applying financial strength ratings. And we want to look at stocks that have a financial strength rating of B++ or better. Now, financial strength is a factor in the calculation for safety, as I mentioned earlier. But we're going to double down and include financial strength. These grades range from C to A++ in 9 increments, okay, in 9 steps. We're going to go with companies that garner a financial strength score of B++ or better. Similar to the safety ranks that we just used, we want a balance of good balance sheet and financial stability, but we still want some good upside potential, right? That's why we're not limiting it to stocks that have a safety of 1 only. We're still including stocks that have a safety of 1, 2, and 3. We're not limiting it to stocks that only have an A++ financial strength score. We're including A++, A, and B++. So we're looking at the upper half of the range for both those measures, the upper half of the range. We're looking at B++ and above, 3 and above. Okay, by applying that criteria, we've now cut the list down further from 2,086 down to 932. Okay, so we've whittled the list down quite a bit already. So we're going to apply one more risk measure. This is one of my personal favorites to look at. It's the beta coefficient, and that can be found in the company data section. It's the beta coefficient, okay? Thank you, Alan. And the criteria that we want to apply specifically is we want to look at beta coefficients between 0.90 and 1.1. Now, I'll explain why that is. The market beta, the beta coefficient for the market is 1.00. What is beta coefficient? So for anyone who's not familiar, beta is a relative measure, okay? It's a relative measure of how sensitive the price of a stock is to the overall fluctuations in the broader market. Okay, so for example, a stock with a beta of 1.5 indicates that the stock tends to rise or fall 50% more than the broader market. Okay, so just FYI, when we say the broader market, we're referring to the New York Stock Exchange Composite Index. Okay, that's what I'm talking about when I say the broader market, the New York Stock Exchange Composite Index. So a stock with a beta of 1.5 indicates that the stock tends to rise or fall 50% more than the broader market. So today we want to narrow our candidates to stocks with a beta of between 0.9 and 1.1. In other words, we want stocks that will largely move in line with the broader market, but at the same time, we want to give ourselves a little wiggle room. Okay, we want to give ourselves a little wiggle room to the upside or downside. We want a little bit of room for a stock that is not perfectly in line with the market. Okay, so by applying that criteria, we've now cut our list down further from 932 to 420. Okay, so we started with 5,700, and now we've got it down to 420. Okay, now that we've looked at risk measures, let's apply some performance metrics, okay? So we're going to start in the ratings and ranks section and look at the timeliness ranks for industries, okay? We're going to start with industries and work our way down to individual stocks, but let's start with industries. Specifically, we want to look at industries with a timeliness rank of 20 or better, okay? Just for a little background information, we have 98 distinct sectors under value line coverage. Okay, there are 98 distinct industries under value line coverage. Right now, we want to look at the 20 best performing industries, or what are expected to be, what we project to be, the 20 best performers in the next 6 to 12 months. Okay, so we want to focus on industries that have a positive outlook in the coming 6 to 12 months. So by applying that criteria, we've now cut our list down further from 420 stocks down to 90, okay? So we're gonna look at another performance measure. So we started with industries, now we're gonna work our way down to individual stocks. We wanna stay with the theme of near-term prospects. Staying in the ratings and ranks section, we're going to apply another filter. This time, timeliness ranks for individual companies. Okay, so we want to look at timeliness ranks of 3 or better. So again, for people that are not familiar, timeliness is a proprietary value line measure. It's one of our tried and true, time-tested measures. It evaluates a stock's projected price performance in the coming 6 to 12 months. It's a pretty straightforward scale from 1 to 5, with 1 being the highest. So that's a 1 would be the stock that we expect to be among the best performance in the next 6 to 12 months. Today, we want to focus on stocks that will, at a minimum, move in tandem with the broader market, okay? But still give us a little upside beyond that. So we're going to set the screen to stocks that are ranked 3 or better. So that cuts our list down from 90 down, now we're down to 58. So we're moving along, okay? The next screen we're going to apply is similar to the timeliness rank, but it's called the technical rank, okay? So for people that aren't familiar, the technical rank, so the timeliness rank attempts to quantify the outlook for the equity, okay? Timeliness ranks looks at the outlook for the individual stock, the individual equity. Technical score is more focused on the company's operational performance. So not so much, it's not as, the timeliness is a little bit more based on fundamentals. It's more based on stock performance. Technical is based on the company's operational performance. So we're going to look today at companies with a technical score of 3 or better, okay? And by applying that criteria, we've now cut our list down from 58 to 41, okay? We're going to apply one more performance criteria by looking at 18-month TPR midpoint. Okay, this is another one of my personal favorites. 18-month TPR midpoint. Okay, and that's in the company data section. Thank you, Alan. And we're going to look at companies, or stocks, I should say, with projected 18-month performance of 45% or better. And let's apply that filter and see what we do. So by applying that final filter, we get it down all the way down to 12 stocks. So we started with 5,700 stocks. We started by applying what we call risk measures, risk criteria. That's safety and financial strength. Then we moved on to the beta coefficient. And then we moved on to performance metrics, timeliness ranks for industries, timeliness ranks for individual stocks, technical ranks for individual stocks, and then we're looking at 18-month TPR midpoint. That's the appreciation potential in the next 18 months. Okay, we've got it down to 12 stocks, and I think that right now you can actually make a pretty good case for any one of the 12 remaining candidates. Okay, but after speaking with our senior analysts and consulting with Alan and Charlie, we prefer and we recommend FleetCor Technologies. Ticker symbol is FLT. Before we click on FleetCor, please note that screens can be saved and revisited by utilizing the Create Save Screen button. That's on the top right there where Alan is indicating. You can save that for future reference if you want to come back to that in the future and take a look at it. Once you save that screen, you can actually modify the criteria within that screen after it's saved. So it's nice. It's very flexible. It's very user friendly. You can save the screen. You can save it by a different name. You can say December 2022 low risk, good upside potential, or some name. You can come up with a name that would be memorable for you, and you can modify that criteria in the future. Okay. So first, we're going to take a look at the digital report for FleetCor Technologies. So Alan, if you want to go ahead and click on FleetCor. All right. So like I said, you can pretty much make a pretty good case for any one of these stocks, but we think FleetCor kind of has that balance of financial stability and upside that we like, especially on the upside. This is a company that I think really has good potential in the coming 18 months. So this is the digital report. This is kind of like the landing page. When you click on an individual stock, you'll see that it has a lot of different information on here. We have a lot of commentary on here. We have a lot of rankings on here. For those of you who are not familiar with FleetCor, the company is a leading independent provider of corporate fuel cards, payment solutions, and other services in North America, Latin America, and Europe. FleetCor's corporate charge cards cater to commercial fleet vehicles, major oil companies, petroleum marketers, and government entities, among others. So with all of that rigmarole out of the way, Alan, do you want to click on the last full page report for FleetCor? Let's click on that last PDF and take a look at it. So this is the latest report for FleetCor. This is the latest full page report, I should say, for FleetCor. This was published, I believe, in November. I think it was November. Yes, it was November. As you can see in the statistical array, or the center of the report, that includes all of the financial data, FleetCor's operating performance has rebounded sharply following a slight dip in 2020 at the early onset of the COVID-19 pandemic. So they've bounced back very sharply. They actually held up reasonably well even during the pandemic, but they've bounced back very sharply since then. Revenues and earnings per share are on track to each advance about 21% this year, the year about to end. And we think each measure could improve another 8 to 10% in 2023. So there's still room to run for this stock next year and beyond. The company has a growth via acquisition strategy, and that strategy has been highly successful for the company for more than 2 decades. Its results are bolstered by partnerships. They have partnerships with companies such as Amazon, Citgo, BP, Chevron, and Speedway. So if we take a look at some of the quantitative metrics for this company, we see the stock has solid marks across the board. Alan, if you zoom up to the top of the page there, we can show them the safety rank. So if you can see that the safety rank for FleetCor is pretty solid at 3. And we can also see that the bottom right of the page, the bottom right section of the page, we can see that the company has a financial strength score of B++. So it's, pretty solid, pretty good metrics. It also has a beta coefficient of 1.10. So again, it's going to move more or less in tandem with the market, but a little bit of upside, right? There's a little bit more juice to be squeezed there. A little bit of upside there. We like that. The issue is ranked to mirror the market in the year ahead because it has a timeliness rank of 3. But if you look beyond that, upside potential in the 18-month and 3 to 5 year windows is well above average. So if you look at the 18 months, the stock is projected to increase about 45%. Just for background, the market, by our Value Line's projections, the market is going to appreciate about 20% in the next 18 months. Okay? This company, the stock we are projecting is going to increase about 45% in the next 18 months. So it's going to handily outperform the broader market in the next 18 months. If we look even further out, if we look 3 to 5 years out, we think that the stock could possibly double in price over that time frame. So 3 to 5 years out from now, the share price could possibly double in price over that time frame. So pretty good upside potential, very solid metrics across the board, good safety rank, good financial strength, decent beta, but it still has upside potential. This stock still has room to run. That's what we like about it. All told, we think that FleetCor Technologies is poised for strong results in the year that's about to end, that's 2022, and next year, 2023, and beyond that. We think the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. FleetCor Technologies, ticker symbol is FLT. Okay, we will now tackle your questions. Please note that we typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. I am going to turn the floor over to Alan and Charlie. They're going to take some of your questions. The first few questions were submitted prior to this presentation. So I'm going to turn it over to Charlie and Alan. Guys, you have the floor.
Hi, this is Catherine, the WebEx producer. Charlie, if you're speaking, we cannot hear you and you are muted.
Hello, this is Charlie Moran. I am a senior analyst with Value Line, and I will be taking some questions that have been mailed in prior to our presentation. One is from Ronald, who writes in, are special one-time dividends added into your yield calculation? Which is a good question. They are not at this time. The yield that you see at the top of the page, if Alan can scroll up there, is just a function of the dividend policy set forth by the company. Any additional payouts that may be special are not represented in that percentage. This is kind of a timely question considering a lot of companies in the energy sector and the exploration and production sectors are paying out a percentage of their cash flows in addition to their regular yield. However, again, that is not part of the calculation that you see at the top of the page. He also asks about the capital structure box and if you could explain the percentage of capital. And if Alan could scroll down there to the left-hand side, as you see in the case of Fleet Core, you have 64% of capital, I believe. My eyes aren't failing me. And that represents a percentage of the debt as a percentage of the total capitalization of the company. That would be the equity and the debt included, comprising the total capital. Let's see. Brian asks, is there any way for more updates to be more frequent with regard to the companies? As Sharif had mentioned in his opening remarks, if there are actions or things of nature that are important where price action moves or the company has some type of breaking news, we will write supplementary reports that are included that morning, that afternoon, whenever news is breaking. You can read these in conjunction with the quarterly reports. Also, Darren asks, what sectors do you see outperforming in 2023? Well, we don't have that type of specific information or don't make those projections. And he asks about certain sectors that we favor. Darren, we don't, again, have a take on which sectors will perform or outperform. However, the industry ranks that Sharif mentioned are included on the page when you go onto the dashboard and arrive at a stocks page on the dashboard. If you scroll down, you will see the industry rank is on the left-hand side of the page, and it corresponds with the stock that is mentioned on the left-hand side above the prior paragraph that was written on the stock. As far as that, I do not see any more questions. Alan, do you have any questions that you've received?
Thank you, Charlie. Yeah, there are a couple more that came in, and one subscriber had a question about the how do we know Violent expects a 20% increase? And I believe they're referring to the 18-month appreciation potential. As Sharif alluded to, we expect stocks on average to return about 20% over the next 18 months. So I believe that's what the subscriber is alluding to with that, and we project this stock in particular to increase 45% over that time frame. So we're looking forward to more than double, compared to the average stock under our review. I just wanted to address that question. Another question that came to that came up was, how do you specifically, how do we pick one stock out of the 12? And that's an excellent question. And we run these screens. The three of us, as well as other people in research and on our economic team, we generate screens, and we try to pick the one stock to buy right now. And once we get the list whittled down from like several thousand, as Sharif said, down to 10, 12, whatever it may be, it's usually right around that number of stocks. Then we, the three of us and a couple other people, some of our senior analysts and economists, we have an in-depth discussion about what do we think is the best stock to buy right now, what's the best stock to own right now. So it's a process, and it starts with the screen, and it continues through extensive conversation. So that's how we get our one stock to buy right now. Also, somebody had a question about the timeliness rank versus the technical rank, and the technical rank is, as the name implies, is mostly it's based on technical factors, whereas the timeliness rank, though it does have some technical factors, it has a lot of fundamental factors baked in as well. So it's kind of two different ways to predict the stock's performance. One on a technical, based on technical factors. The other one is, I would say, a mixture of most technical and fundamental, but maybe a little more tilted towards the fundamental side. So, but I think it's good to look at a stock based on both of those factors, as Sharif alluded to. And the last question I saw is, someone had asked about the 18-month total return, and we instituted the 18-month total return, several years ago, and our timeliness rank is based on performance over the next 6 to 12 months, and we've always had that, and we've always had our 3 to 5 year projections, and we thought it would be, especially the volatility of the market, et cetera, it'd be good, to look at stocks at an intermediate term basis. So that's why we instituted the 18-month total return, and that's updated as well, each week, based on our expectations and the stock market's changes, et cetera. So our 18-month, prospects, they change somewhat each week, as do the 3 to 5 year total returns for the survey as a whole. So I just wanted to point that out as well. But I think that's all the questions that we had. We thank you all for joining us, and we hope you have a great holiday season. Thank you.
This does conclude today's presentation. You may now disconnect your lines and have a great rest of your day.